Ladies and gentlemen, welcome back to the channel. We had a great day today for Tesla stock and generally for risk on assets. Now here in this video, I will discuss my expectations throughout the rest of this week. Some breaking news today here that you need to know in regards to the whole Trump, Zelensky meeting and the latest details on that. I think that Wall Street's still a little bit nervous because a deal is not done yet. Something could fall through. And once that is set in stone, signed papers, I think that is a big de-risking factor for markets, because at this point, markets don't care about the war in Ukraine at all. If it ends, is that a slight positive? Sure. But what Wall Street really cares about right now is, let's just make sure China does not get an additional tariff put on them for buying Russian oil. Okay, so we'll discuss all of that here in this video. I do have a couple of clips from CNBC that I think you really need to see. Some bullish ones, some not so bullish ones. And these are, if you guys don't know, I watch all clips from CNBC. I like to stay very well-rounded from what hedge funds and institutions are saying. I think that is a superpower or skill of mine, and I'm going to share with you the ones that I think you really need to hear. They're only like 2-3 minutes long a piece, not a big deal. Skip them if you don't want an edge, but I highly recommend that you guys pay attention to that. Now, with that said, let's get into today's episode. Hit that like button and subscribe to the channel if you have not done so already. Check out that link down below in the description of this video. The stock that I have almost $100,000 invested in now went crazy today, up like 10%. Heading into their earnings report on Thursday, there's a lot of reasons to believe that stock is about to go parabolic. Just my view, just my thoughts. I'm not a financial advisor. I'm not a financial planner. I am not going to give you a guarantee because you could lose all of your money clearly when investing in markets. So contact a financial advisor before you ever make an investment decision. And keep in mind, if you sign up to the trading community, there is always going to be scammers trying to scam your money, no matter where you are. The only thing that I provide is my links, nobody else's links. If people are trying to get you to click on something, I run that platform. Okay, I have moderators. We have people that are very close in that group that can do specific things, but nobody is ever going to send you a link to sign up to anything. So do not fall for that. Okay, it's unfortunate when people do, because what can you do? Okay, the only links you should ever click on are the ones that I send you. Okay, with that said, ladies and gentlemen, let's get into today's episode. So first and foremost, this week, really over the next couple of days, whatever headlines come out from the Ukraine, Zelensky, Putin, conversations or headlines are going to be important for markets, again, because of the threat that we could have additional tariffs put on China. That's really what matters. The further we get away from that, the better. Trump said today that he does not feel the need to retaliate on anyone else because this conflict is heading in the right direction. Okay, hopefully it ends. That could be an incremental positive, but really the big story for this week is going to be one, Jackson Hole on Friday, when Jerome Powell is going to be giving a speech. Some people think he's not going to indicate rate cuts at all. He's going to take this whole neutral approach, watch the data, quote unquote. I think Powell could be a little bit more dovish than people think. Maybe he signals, a willingness to start cutting rates. In reality, doesn't matter. Probably not. The Fed rate monitor tool is pricing in about an 81% chance of a September 17th cut. So even if Powell is not like super dovish on Friday, you're still going to get a cut. There's so many Fed officials now that are team rate cuts. September is virtually a guarantee. Now, Goldman Sachs came out today and said that they expect 2 to 3 rate cuts this year. What's really going to move are the odds for October, okay? The odds for October 29th flipped today. So now you're not pricing in a cut in October. There's a 48.1% chance of a cut in October and a 43% chance of a pause, okay? December, you're pricing in another rate cut. So technically, you're only pricing in 2 cuts. One in September, one in December. So all the economic data that we get between now and September likely is not going to change a September cut unless the economy is just really good and inflation comes in hot. Okay, assuming that doesn't happen, we're going to get a cut in September, but it's really going to move the odds for October and December the most. Okay, that is what we need to be watching here at this point. Now, a big catalyst coming this week that I want you all to be familiar with is earnings. Okay, a lot of retailers. So retailers are important because people tend to spend all of their money. That's just the fact. That's the American way, if you will. Okay, hopefully you don't. Hopefully investing a good percentage of your income into assets. Okay, but these earnings from retailers are going to tell us a lot. We get a lot of noisy economic data. A lot of it not good. A lot of it small sample size. A lot of it just could be fraudulent. Who knows? Okay, but earnings are different because companies and executives have a legal obligation to be honest, no matter if it's good or bad. So you're going to get earnings from Home Depot, Target, Zim, not a retailer, but TJX, okay? I don't think Zim's a retailer. Maybe. It honestly doesn't matter. TJX, Target, Home Depot, Walmart, okay? Walmart being the biggest one, okay? If Walmart on Thursday in pre-market says good things about this economy, that is a green light, okay? That is confirmation that we are likely not heading into a recession. Likely confirmation that things are going fine. If Walmart says there is more weakening, people are slowing down even more, consumers becoming even more cautious, that is a bit of a red flag. Now, obviously, if Walmart says they're seeing a drop off in sales, that's obviously an even bigger red flag, okay? So Walmart, I think, is bigger than any Walmart's earnings and conference call. I think is bigger than any economic data. And I actually think Thursday morning, the entire markets are going to move on Walmart's earnings. So I think that is a major catalyst that you need to be prepared for right now. You need to have your ducks in a row in case Walmart says bad things or good things. Like, this is not the week to be YOLOing your portfolio on weekly options when we just don't know what Walmart's going to say. Now, odds are good that they say things are fine. Maybe they say the consumer's improving a little bit. Like, that would be a huge positive catalyst. The fact of the matter is, we just do not know. Be careful this week. It's going to be more volatile than people think. Now, Zelensky says today he is open to holding an election after peace, but can't hold an election during the war. Trump says he doesn't think there will be a ceasefire. Now, Zelensky says a deal could aim for peace while fighting continues, not that we need a ceasefire. Trump says that they're going to be discussing security guarantees. Now, there is no expectation today ends with the date on the calendar for a trilateral meeting, according to Fox News. Now, US and Europeans have gently made suggestions on territory, but they are also aware that Zelensky has to take this back and massage it through its own system. It says, quote, gotta come back with a counter offer, Fox reporter says on X. Zelensky was asked about what security guarantees he needs, and he says everything. Trump says if we have a trilateral meeting, there's a good chance this ends. Trump says he plans a call with Putin after he wraps up his meetings today with Zelensky and European leaders, that he says, quote, he's expecting my call. So later tonight, we could be getting some news. Kremlin states they will reject any Western troops deployed on Ukrainian land. Now, specifically for Tesla stock, again, I just want to make it very clear, you are still in a technical breakout, and there is reason to expect Tesla stock to move higher. I think at this point, the fear is quite large. We've reported on this before here on this channel, like the AI investor sentiment survey. People are very bearish, 46.2% bear, 24% neutral, 29.9% bullish. People are not very bullish right now. What's interesting, again, ever since Tesla's earnings, hedge funds and institutions have gotten more bullish on Tesla. In fact, since Tesla's earnings, some of the lows hit after earnings, Tesla stock is up about 12.5% from that level, and now in a technical breakout. What we've seen is they've gotten a lot more bullish on Tesla stock, and retail has gotten a lot more bearish. I think that is a mistake. I think into the end of this year, especially, Tesla is going to rally. Now, what happens this week could be largely dependent on any, Putin, Zelensky, Trump headlines that come out on peace in Ukraine, which could be a positive, could be skewed towards the positive. You also have Walmart earnings. You have Jerome Powell's speech on Friday. All of that going to be very important for Tesla and definitely move the needle for the stock. Now, I generally think you've seen this de-risking in risk-on areas like Tesla, like other small caps. That is the area that outperformed today, and I expect, in my view, that we will get this outperformance of high beta and small caps into the end of this week. I think Walmart's probably going to be, have good things to say or pretty neutral things to say. I'm not expecting some kind of disaster warning from Walmart. If anything, they may say consumers getting a little bit better here. Okay, that's my thoughts. And I think Powell is largely expected to be neutral. If he does take more of a dovish approach towards cutting rates, that could be a positive that is not priced in at this point for Tesla stock. But again, if you want to diversify away from Tesla, but also stay in AI stocks with massive upside potential, 10, 20, 30x opportunities, come check out the link down below in the description of this video for the trading community. Look, guys, portfolio for the trading group is up 78.5%. We are in the top 1% of hedge fund and institutional performance, okay? The results are here. The results are happening. And honestly, I think this week is going to be a massive week for this portfolio because one stock in particular that we have almost $100,000 in, invested in multiple portfolios, of course, not just this one, is set to report earnings on Thursday. And I think we're going to see a pretty massive explosion higher in that stock. But again, hey, I could be wrong. Always do your own due diligence. Contact financial advisor before making investment decision. With that said, again, just to be clear, I am very bullish on Tesla stock, especially into the end of this year, but there could be a little bit of choppiness around September, and that is worth reminding yourself of. Now, with that said, I want to get started with a couple of these clips from CNBC that I think you really need to hear. First and foremost is this one from Truist Wealth's Keith Lerner. Says bull thesis holds even with expected choppier near-term environment.
It could be a big week for stocks with more earnings and Fed Chair Powell's speech at Jackson Hole. Let's bring in Keith Lerner, Truist Wealth Co-Chief Investment Officer, to discuss. Let's start with Jackson Hole because some out there are saying that could be potentially bearish for stocks, especially if Fed Chair Powell indicates to the market something a bit more hawkish than they may like to see. What's your expectation for Jackson Hole? Do you think it will be a sell the news event?
First, great to be with you. To your point, when you look at the Fed funds futures, we're pricing in about an 85% chance of a Fed rate cut in September. So the market wants to see a little bit of an inclination. Listen, I think he's still going to kind of hold things somewhat tight because we do have two inflation reports, and probably the most important report in my mind is the September 5th employment report to see if the revisions that we saw were maybe somewhat overdone. But to your point, I think expectations are somewhat high, and you could get a little bit of a setback. But all in all, I don't think that's going to disrupt the underlying trend for the market, which is still higher. What I think could happen is really what you're seeing in like the small caps, the home builders, they're really banking on on that cut. So that's where I think you'll see more of the action.
So if he were to kind of indicate that a 50 basis point cut in September is off the table, maybe something like 25, and then reserve optionality for October and December, how do you think stocks would react to something like that?
I think the market would act well to that. Again, I don't know that he's going to come out and really say that we're going to get the cut. But again, we're looking for a little bit more of a dovish language, a little bit of a hint that the balance between inflation and employment has changed to let them at least have an insurance cut in September. And I think if he does do that, then maybe you'll see a little bit more of this rotation that we've seen the last few weeks continue. But, big picture, for the S&P 500, I don't think, cuts are crucial necessarily because think about what's driving that is tech, communications, and they have, more focus on the secular growth story. And the market hasn't seen any rate cuts this year, but the S&P is still up 10%. These other areas of the market are still well below their former highs.
I also want to share this clip with you. It says the market is likely to broaden out in 2026, says Citibank's Rob Rowe. Take a listen.
There was an interesting chart that caught my eye from Apollo this morning on this whole AI theme, which showed that historically private consumption has represented about 70% of GDP growth. And in 2025, there's been this inflection point where now it's the AI spending contributed to the same amount as private consumption for that GDP growth. And I'm just curious, what you think that means and kind of what that says about the stability of where GDP is right now.
Well, GDP, at least in the U.S., we anticipate it slowed in the first half. I think we were at 1 to 1.5%, and our anticipation for the remainder of the year and for the second half is 1%. So the market is, the economy is slowing down a little bit. But when it comes to AI and CapEx, I think that's a different story. I think markets and others are looking beyond what could be a slowdown in the U.S. this year and looking into next year in terms of what the potential growth could be as a result of these, tech and innovation that we're beginning to see.
Yeah.
I think adoption rate is one of the things we're looking at right now. Like when we look past, at the dot-com bubble back, turn of the century, it's really a matter of a lot of tech and innovation comes in, and then the adoption rate is a different matter, and that can take some time. To your point that you were saying, we could see that adoption rate take a little longer than anybody expects. But the other thing I would say about the AI companies is when we look at things on a PEG ratio, they're actually valued fairly well versus growth. If you were looking at a growth opportunity, there's still good valuations here relative to where you anticipate growth being.
Yeah, I guess another way to ask the question is whether or not you think the economy is becoming too reliant or too dependent on AI and some of this CapEx spending, which presumably, if, to Mike's point regarding investor patience and just the appetite to keep spending, that's a spigot that could be turned off a lot easier than, say, consumer spending, presumably.
Yeah, no doubt if you're going to be growing that business, you're going to have to grow the infrastructure. And that's what it's been about. I noticed the discussion on software. Software isn't the focus right now. It's really the data centers, the power grid, the chips, everything that needs to be built up to handle large databases, to handle all of the operation and consumption of that data and innovation. Another interesting to look at is that services is now 40% of global exports. And part of that's growing is a thing called digital services exports. That's been growing exponentially. So again, these are cash flows are very strong, as opposed to the turn of the century when there weren't any cash flows. Now you have very, very strong cash flows that are driving this. And most of that CapEx and infrastructure has been funded by cash. It really isn't a matter of these companies leveraging up in some way.
So you're not a fan of the recent analogs to 98, 99?
Not as much,
No.
Because back then you had a lot of over-leveraged situations. You didn't have a lot of companies that had earnings. Here you're talking about companies that have very solid earnings, very strong cash flow, and they're funding a lot of this growth through that cash flow. So in many respects, it's a little different than then.
Yeah, the concentration risk, of course, is one that a lot of people have been concerned about. Is that something that has, given you pause?
We do expect a broadening out at some point. Probably now I'm beginning to think that happens next year. So we would encourage folks to look at other industries and other sectors. But right now it's still the growth driver. If we're in on the whole growth aspect of this, and we're still overweighting tech and communications.
So obviously hard to disagree with that one. Now, the last clip I want to share with you is one that is not so good. It says recession risks are really high, says Moody's Mark Zandi.
Morning.
Good morning.
Goldman writes a note today, says that some of these revisions are likely to start triggering some SOM rule recession fears. Are you anywhere near that camp?
Yeah, I think recession risks are really high. I think the key here is jobs. I think that's the right place to focus. And of course, with the recent data, we see job growth has come to a virtual standstill. And I don't see any reason why we'll see any pickup here anytime soon. So, if we start getting some negative job numbers, which I think are really very, very possible, that would be a clear indication of recession. The SOMS rule is around the unemployment rate, Carl. If it increases more than about a half a point on a 3-month moving average, that historically has signaled recession. Interestingly, that may not be quite as telling this go around because unemployment may not be the indicator to watch because of the weak labor force given immigration policy and some other things. We may not see unemployment rise to the degree that we have historically, belying the weakness in the economy, but nonetheless. So the SOMS rule may actually not be the indicator to watch. But everything else strongly suggests that the economy is in trouble here.
Right. So 2 questions. Is a negative print part of your base case anytime in the next, by the end of the year? And where do you think break-evens are right now?
Yeah, I think break even, so that's the rate of monthly job growth consistent with stable unemployment. That's probably around 25, 50K, somewhere in there, and that's kind of sort of where it feels like underlying job growth is now, abstracting from the vagaries of the data and measurement issues, that kind of thing. But if the probability of a negative print, a negative number is pretty high. I think it's going to be difficult not to see some negative numbers here. And historically, it's a negative payroll employment. That is when the National Bureau of Economic Research, the folks that date business cycles, date recessions. Once that we go negative, that month that employment goes negative, that's the month when recession begins. Now, of course, you have to see a string of negative numbers. I mean, a recession is a persistent decline in economic activity. So it's not just 1 or 2 months, which seems very likely. We'll need something more than that to get a recession. But that number is going to be key to deciding when recession begins here in the next few months.
Can you explain, just technically speaking, how some of the immigration policy may be masking some of the underlying employment weaknesses that you're seeing? What numbers are you looking at to indicate that, and kind of how do you see that filtering through to things like consumer spending and overall economic growth or recession?
Yeah, sure. So, obviously, immigrants have been key to the growth in the labor force. I mean, if you go back a year ago, before the more stringent immigration policy went into effect, we were seeing a foreign-born labor force growing 4 or 5%, very strong. Now it's actually declining. The stringent immigration policy started to kick in a year ago with Biden's executive order on asylum seekers, and of course President Trump has reinforced those policies, and so labor force growth has for the foreign-born has actually started to decline, and the result of that is overall labor force has gone flat. So the size of the labor force today is actually lower than it was at the start of the year. And so because of that, that's keeping the unemployment rate, down. So you can't really look at the unemployment rate as a gauge of the strength of the economy. It's really about jobs and job growth slowing. So, and by the way, this is really important to longer term growth. Obviously, the potential growth rate of the economy, how fast can the economy grow without generating inflationary pressures, is critically dependent on the growth in the labor force. So if the labor force isn't growing, then the economy's potential is a lot slower. We're not going to be able to, maintain growth rates that are very strong for very long without generating inflationary pressure. So this is very important. The other thing about immigration that's really key here is that it's about demand. One other indication of the economy's weakness is consumer spending all in. Real consumer spending in aggregate has gone nowhere this year, and that may be in part because of the immigrants deporting or pulling back on their spending given the situation that they're in, and that's weighing on consumer spending broadly.
So let me know your thoughts on all of this down below in the comment section. Hit the like button as well as subscribe to the channel. Check out that link down below in the description of this video as well. All I'm going to say, buckle up. This week could actually be quite volatile, but I'm excited. I think Tesla stock goes higher. I think higher beta, risk on, small caps also go higher. Let me know your thoughts on that down below in the comment section. Have a great rest of your day, and I will see you in the next episode.